This is Miles Wood McGrath, Head of Investor Relations at Argonaut Capital. I'm with Barry Norris, covering the Argonaut Absolute Return Fund for May 2023. So Barry, how did the fund perform last month and what did the markets do?
Well, Miles, May saw a rally in AI-related technology stocks and a sell-off in almost everything else, particularly anything related to China, where the reopening recovery trade seems to have stalled. The fund delivered plus 2.5% in May. That's against a market return which was negative. And now in negative months since the fund has launched, in those negative months for the market, the fund has delivered plus 57%, whilst the market has delivered in negative months only minus 89%. The short book had another stellar month with short positions in Swedish property outfit, Sam Hall, Byggnadsbolag, Nordic cable duct manufacturer Hexatronic, and IDS, the UK postal service run by the trade unions, formerly known as the Royal Mail. We also had some decent winners in the long book, US builders merchant First Choice, Norwegian Air Shuttle, and actually, and this might come as a surprise to many of you, we're long one US regional bank, First Citizens, which performed strongly as it managed to cherry pick the assets of the failed Silicon Valley Bank from the FDIC. We continue to reduce both our net and gross exposure and rotate cyclical exposure into quality and duration factors in the long book, likely to be more resilient in a recessionary environment. And in the short book, we obviously maintained our financial shorts, but also added to some shorts in cyclicals and initiated some new shorts in commodity equity.
You have suggested a global liquidity crunch is inevitable. Why?
Well, here's a scary fact that the US money supply is currently already contracting at the fastest pace since the Great Depression in the early 1930s. And it's likely to contract further because banks focusing on liquidity will be keeping their cash back at the Federal Reserve on deposit rather than lending it out. In addition, the Fed's doing quantitative tightening of about 95 billion per month, and that compares to the money supply overall of about 20 trillion. And now that the government debt ceiling has been extended, having run down the Treasury General account in the first half of the year, which has boosted liquidity, the federal government will replenish its liquidity by issuing T-bills and treasuries of up to $1 trillion. And the question is not whether those auctions will succeed, but what will get sold to fund that $1 trillion of new liquidity or new issuance from the Treasury. And if you think about it, the inverted yield curve creates a lot of problems in that commercial banks can currently get 5.2% depositing their cash back at the Fed as bank reserves. Money market funds and non-banks can currently get 5.05% depositing their cash at the reverse repo. And the inverted yield curve suggests that all of those T-bills and treasuries will have lower yields than that. So when asked this month, Jamie Dimon, the CEO of JP Morgan, said to a question about where is he putting JP Morgan's money at the moment, he said, back at the central bank on deposit. And therefore, this is going to lead to a global liquidity crunch simply because there's going to be an absence of funding in the real economy and the financial economy. And this will also lead to a shortage globally of dollar funding, which will start to impact on the global economy. So this is currently happening gradually, but then it will happen, in my view, very suddenly, probably over the coming months.
Isn't bad economic news now good stock market news? And will this potentially lead to Fed rate cuts?
Well, I think bad news is only good news if you believe that the Fed put is going to come into play at an early stage. And I think this notion of the Fed put has bailed out bad investments and bad investors ever since the global financial crisis. It's I think important to bear in mind that the Fed officials are aware of the mistakes of their predecessors in the 1970s and early 80s, who, in their view, cut rates too early with regard to economic weakness. And as a result, inflation came straight back. So Paul Volcker, for example, in the early 80s, cut rates too quickly. And as a result, inflation went straight back up again. Volcker had to push interest rates even higher. And as a result, the US had not one recession, but two. So I think there are some doubts about the veracity of the Fed put at the moment. And then really needs to be some purging of the system in order to get inflation down. And that requires a recession. So I think it's a bit naive to think that markets are already discounting a big recession and and all the bad news. So I think at the moment, the best thing for investors to do is to think about the downside risks and conserve capital so that they've got capital to go back into the market at lower levels when the economic news is much worse than what it is at the moment.
Lastly, Barry, why would now be a good time to think about allocating to the fund?
Well, I think proper diversification of portfolios requires investing in uncorrelated assets. And often we see people thinking they're diversified, but actually all that they've done is invest in a number of different assets that are all highly correlated to each other. And I think whilst obviously there are loads of funds out there that do well when the market does well, there are a few funds like ours that have a track record of doing well when the going gets tougher. And so this diversification argument about you can only eat the free lunch of diversification if you invest in non-correlated assets, that's incredibly important. And look out for a new stockumentary video coming soon about this. And I think in order to generate an uncorrelated return, in the equity market, you need to be able to short as well as go long. And obviously there are a few funds with our track record of delivering consistent short alpha over a number of years. And I think finally, as we've talked about, there's a tactical element in that the best returns of 2023 are likely behind us. There is, I think, growing evidence of significant downside risks to both economies and financial markets, and therefore uncorrelated returns are likely to become more valuable again.